This is a question from the comprehensive illustrations section of financial instruments, illustration number 2. All right. So after the chapter, you have a separate section called comprehensive illustrations, and this is illustration number 2. A Limited issues 1 crore optionally convertible bonds on 1st of April 2021. The bonds have a life of 8 years and a face value of rupees 10 each. They offer interest which is payable at the end of each financial year at the rate of 6% per annum. All right, so the coupon rate is 6% per annum. The bonds are issued at their face value, and each bond can be converted into one ordinary share in A Limited at any time in the next 8 years. All right, so it can be converted into one share in at any time in the next 8 years. Companies of a similar risk profile have recently issued debt with similar terms without the conversion option at a rate of 8% per annum. All right. So the market rate is basically 8% per annum. All right. The market rate is 8% per annum, which we will use as the discount rate, and the coupon rate is 6% per annum. The question is provide the appropriate accounting entries for initial recognition, calculate the stream of interest expense across the 8 years of the life of the bonds, and provide the accounting entries if the holder of the bond elect to convert the bond to ordinary shares at the end of third year. All right, after receiving the interest for the third year. Remember, the option to convert existed at any point in time in the next 8 years. The question is actually asking for the accounting entries if, let us say, the holder actually chooses to convert the bond at the end of third year into equity shares. Firstly, clearly you should identify that this is a compound financial instrument because the entity has an obligation to issue cash, and it also has an obligation to issue a fixed number of equity shares. All right, so therefore this will be classified as a compound financial instrument. Therefore, at initial recognition, we have to calculate the split of the amount of 1 crore. All right, remember we have issued 1 crore worth of debentures or bonds. Therefore, we have to split this 1 crore into liability value and into equity value. How are we going to do it? We will be calculating the liability value as the present value of the cash flows that an entity may be obligated to pay. All right, so the liability value will be calculated as, we'll plot down years where we have cash flows for years 1 to 8. All right, where the cash flows for year 1 to 8 will be 1 crore multiplied by the coupon rate of 6%, which is going to be equal to 6 lakh rupees each year. All right, the coupon rate is going to be equal to, the coupon is going to be equal to 6 lakhs because we have 1 crore of face value and the rate of interest is actually 6%. The discount rate will be 8%. So we have the present value factor at 8%. Also, if the holders choose not to exercise, we may actually be obligated to pay 1 crore rupees. All right, remember the holders actually have an option. All right, these are optionally convertible bonds where the holders may actually choose to either convert it into equity shares, or they may actually choose to actually redeem the bonds in the form of cash. All right, they're optionally convertible, meaning that the holder actually has an option to either get it converted or to receive cash. Therefore, we actually will consider the possibility that we may actually be obligated to pay 1 crore rupees at the end of 8th year. All right, so let's calculate the present value factors and the discounted cash flows. So the present value factors is 5.7466 for 8 years at 8% and 0.5403 for the 8th year. All right, so the discounted cash flow is going to be 5.7466 multiplied by 6 lakh rupees, which is going to be equal to 34 lakh 47,960. All right, and for the last year, for the 8th year, it will be 54 lakhs 3,000 rupees. All right, the discounted cash flow total will be equal to 5403,000 plus 34,47,960, which is equal to 88 lakh 50,960. All right, so 88 lakh 50,960 is the value of the liability. Therefore, equity will be calculated as a balancing figure, which is going to be equal to 1 crore rupees less 88 lakh 50,960, which is going to be equal to 11 lakh 49,040 rupees. All right, so the amount of equity will be 11 lakh 49,040. So therefore, out of the 1 crore that we have received, we are going to actually split it as 88 lakh 50,000 of liability and 11 lakh 49,000 of equity. All right, let's quickly look at the answer. 88 lakh 50,000 is liability and equity component is 11 lakh 49,040. All right. So the journal entry will be, we will record 1 crore of bank receipt and we are going to record a liability of 88 lakh 50,000 and a equity component of 11 lakh 49,000. All right. So convertible bond liability component is 88 lakhs. Convertible bond equity component is the remaining 11 lakhs. Now, the second part of the question actually requires us to calculate the stream of interest expense across the 8 years for the life of the bond. What is the interest expense? Interest expense basically refers to how much amount of expense are we going to recognize in the P&L account. All right, we are actually going to pay an interest of 6%. We are going to pay an interest of 6 lakh rupees every year. So, will the interest expense actually in the P&L be 6 lakh rupees? The answer is no. All right, just because you're paying 6 lakhs, it does not mean that the amount of interest expense in the P&L will also be equal to 6 lakhs. All right, what we are actually going to do is we will be recording interest expense at the market rate of interest of 8%. We are going to record interest expense at the market rate of interest of 8%. We will be applying this 8% value on the liability. All right, on the liability, we are going to actually calculate the interest at 8% on 88 lakh 50,000. We will apply 8% interest to calculate the amount of interest expense. All right. So if I actually calculate the interest expense for year one, interest expense for year one will be 88 lakh 50,960. 88 lakh 50,960 basically represents the outstanding debt value. It is the balance sheet debt value. On this, we are going to apply not the coupon rate of 6%, but we are actually going to apply the market discount rate of 8%. We are going to actually calculate the discount rate. We are going to calculate interest using the market rate of interest, and this is going to be equal to 7 lakh 8,077. All right, it's approximately 7 lakh 8,077. All right, so the amount of interest expense that we recognize will actually not be equal to the cash flow that we are paying. The cash flow that we will pay for year one is going to be equal to 6 lakh rupees. Is this the amount of interest expense? The answer is no. We are going to calculate it using the market rate of interest applied on the balance sheet debt value. What is the debt value? It is 88 lakh 50,000. On that, you apply 8% and we arrive at 7 lakh 8,077. The journal entry for this is going to be equal to interest expense debit. All right, we debit interest expense of 7 lakh 8,077 and we credit to financial liability. All right, to financial liability of 7 lakh 8,077. It is basically like we are actually adding it to the value of debt. All right, we are adding the amount of interest payable to the value of debt. At the end of year one, we would have also paid 6 lakh rupees of cash. All right. That 6 lakh rupees of cash is now not going to be debited to the interest expense. We will actually debit it to financial liability. What we are going to do is we are going to actually assume that it is actually being paid out, and we are going to debit 6 lakhs and credit cash of 6 lakhs. All right. So what have we done over here? The amount of interest expense, we calculated it separately and included it and added it to the amount of liability. Now a portion of that liability is being paid out. All right. My interest expense for the year is 7 lakh 8,000. Out of that, 6 lakhs is being paid. All right. But because the interest is actually being added to my financial liability, I'm debiting my financial liability only here when I'm actually making the cash payment of 6 lakh rupees. All right. So effectively, another way of looking at it is my total interest expense for the year was 7 lakh 8,000. Out of that, I paid 6 lakhs. The remaining 1 lakh 8,000 actually got added to the amount of liability. The remaining 1 lakh 8,000 technically got added to the amount of liability. All right. I'm repeating myself. My interest expense for the year is 7 lakh 8,000. Out of that, I paid 6 lakhs in the form of cash. The remaining 1 lakh 8,000 is technically an addition to the liability. All right, that is remaining to be paid and it is an addition to the liability. That is how we're actually going to look at it. If you think of it that way, the financial liability value at the end of the year, the financial liability value at end of year one will actually be equal to, we started the year with a value of 88 lakh 50,960. We then actually had increased the liability with 7 lakh 8,077, and then we made a payment of 6 lakhs, effectively increasing my liability by 1 lakh 8,000, and my closing liability value will be equal to 88 lakh 50,960 plus 108,077. All right, it is effectively increasing by 1 lakh 8,000. So my closing balance will be equal to 89 lakh 59,037. All right, so my liability value at the end of year one will be 89 lakh 59,037. Now, for calculating interest for year two, I am actually not going to calculate interest for year two of 8% on the initial 88 lakh 50,000. 88 lakh 50,000 was the liability that was outstanding in year one. In year two, the liability that will be outstanding is actually 89,59,037. All right, this is my financial liability at the end of year one, which means throughout year two, all right, for throughout year two, the liability or the debt that is outstanding is 89 lakh 59,037. Therefore, my interest for second year will actually be calculated based on the revised debt amount of 89 lakhs 59,000 multiplied by 8 percentage. All right. So technically what we are doing is this is effectively like calculating interest on interest. All right. We actually had a liability of 88 lakh 50,000. That liability increased by 1 lakh 8,000, and on that revised liability, I'm going to calculate interest for year two. All right, so the interest for year two will be 89,59,037 multiplied by 0.08, which is equal to 7,16,723. All right, again, the journal entry will be the same. It will be interest expense debit to financial liability of 7,16,000 and financial liability debit to cash of 6 lakhs. This time, again, we actually have some unpaid interest. We technically have an unpaid interest, which is going to again increase my liability value by 1,16,000. All right, first year it increased by 1,08,000. Second year it's again increasing by 1,16,000 odd. All right, so my liability is actually going to keep increasing every year. Obviously, now I cannot keep doing this every year, right? Like I cannot keep doing this detailed working each year. So therefore, we actually have a format of a table. We have a tabular format where we can actually calculate the amount of interest, and we can also calculate the closing balance of the liability. What we are going to do is I'm going to have year in the first column. I will have beginning balance of liability. I then plot interest, which is going to get calculated at the rate of 8 percentage. Remember, interest will be calculated not at the coupon rate, but it will be calculated at the discount rate or the market rate. I then have cash flows, and then I will plot the closing balance of liability. All right, so I am, let us say for year one, my beginning balance of liability, my beginning balance of the liability at year one was basically 88 lakh 50,960. All right, at the beginning of year one, I recorded the instrument and had a liability of 88 lakh 50,960. All right, the interest at 8 percentage is basically going to be 88,5960 multiplied by 8 percentage, which is 708, which 077. All right, this interest is going to be calculated on the beginning balance. I then have a cash flow which reduces my liability. Remember, the cash flow is actually going to reduce my liability because I debit financial liability. So I'm actually putting it in a negative signage. The closing balance will be 88 lakh 50,000 plus 7 lakh 8,000 less 6 lakhs, which is going to be equal to 89 lakh 59,000 037. All right, this is what we also calculated above, 89,59,037. Now the closing balance of year one will become the beginning balance for year two. All right, the closing balance for year one will become the beginning balance of year two. So I have got a beginning balance of 89,59,037. All right, whatever is the closing balance here, that is becoming the beginning balance over here. For the second year, I calculate interest at 8% using this value. All right, so that is going to be 89,59,037 multiplied by 8 percentage, which is equal to 7,16,723. At the end of second year also, again I pay a cash of 6 lakh rupees. I pay a cash flow of 6 lakh rupees. So the closing balance of the liability at the end of second year will be 89,59,037 plus 7,16,723 less 6 lakhs, which is going to be equal to 90,75,760. All right, this will be the closing balance of year 2, which will then become the beginning balance of year 3. All right, so I've got a beginning balance of 90,75,760. I then calculate interest on this at 8 percentage, which is going to be equal to 7,26,061. I then have a cash flow of 6 lakh rupees that I will actually pay at the end of third year, and therefore my closing balance of liability will be equal to 92 lakh 1,821. This will become the beginning balance for year 4. On this beginning balance, I will calculate 8% interest, which will be equal to 7,36,146. I then have a payment of rupees 6 lakhs that will be made at the end of year 4 as well. All right, remember 6 lakhs is going to be paid at the end of every year as coupon, and therefore my closing balance of the liability will hence be 92,01,821 plus 736,146 minus 6 lakhs, which is going to be equal to 93,37,966 or 967. I then have year 5, the beginning balance will be 93,37,967. On 93,37,967, I calculate the interest to be 7,47,037. I then have a cash flow of 6 lakhs, and my closing balance will therefore be equal to 94 lakh 85,004 rupees. All right, that will become my beginning balance for year 6, 94,85,004. I then have an interest expense which will be calculated as 7,58,800. On this 94,85, I apply 8 percentage, which will be 758,800. I then have a cash flow of 6 lakhs, and therefore my closing balance will then be equal to 96 lakhs 43,804. For year 7, this will become the beginning balance 96,43,804. I then calculate interest at 8 percentage, which is going to be equal to 7,71,504. I then have a cash flow of 6 lakhs that I'm actually going to pay off, and I will be left with a remaining balance of 96,43,804 plus 771,504 less 6 lakhs, which is going to be equal to 98 lakh 15,308. For year 8 again, I have a beginning balance of 98 lakh 15,308. I calculate interest at the rate of 8 percentage, which is 7 lakh 85,225. I then have a cash flow of 6 lakhs, and I will be left with a closing balance of 98,15,308 plus 785,225 less 6 lakhs, which is equal to 1 crore 533. Ideally speaking, this 533 is actually coming as a result of rounding. If I would have taken the exact interest calculations, all right, I started rounding it without decimals, and obviously even if I would have taken decimals, it's still going to, I'm only going to take it up to, let's say, 2 decimals or so. I would have still exactly, actually I should have been left with 1 crore rupees. Why am I saying we should have been left with exactly 1 crore? Reason being, at the end of 8th year, if I may be obligated to pay cash, I would be obligated to pay exactly 1 crore rupees. If I would be obligated, if the entity chooses, if the holder chooses not to exercise the option, I as an entity will be obligated to pay exactly 1 crore rupees, and therefore my liability in the books of accounts should exactly be equal to 1 crore. Whatever is my obligation to pay at the end of 8th year, that should be my book value of the liability at the end of 8th year. All right, so what have we done over here? We have created a table which actually has the beginning balance, interest, cash flows, and the closing balance. All right, the interest expense that we recognize in the P&L is not equal to 6 lakhs. Although I'm paying a cash of 6 lakhs, I am going to not recognize an expense of 6 lakhs, but I will be separately calculating the expense using the amount of liability outstanding at the beginning of each year. I will see what is the amount of liability outstanding at the beginning of each year. On that, I'm going to calculate using the market rate of interest of 8 percentage, the interest for each year. What goes into P&L is actually this amount. All right, this amount is going into P&L as interest expense every year. All right, the cash flow that I'm actually paying of 6 lakh rupees, that is actually not going to P&L, but I reduce my liability by the same value. All right, this interest expense, I'm increasing the liability. The journal entry for each year will be interest expense debit to financial liability of 7 lakhs, and I will actually reduce my liability by 6 lakhs. All right, so that for that entry will be financial liability debit to cash. So each year, the liability value is actually increasing by 1 lakh odd rupees. All right. So I started with a liability of 88 lakh 50,000 that increased to 1 crore because every year the liability value was changing or was increasing by 1 lakh rupees and odd. All right. The liability was 88 lakh 50,000 that increased to 1 crore because each year I was recognizing a higher amount of interest expense than my coupon payment. I was recognizing a higher amount of interest expense than the actual payment, which was increasing my liability in such a way that at the end of eighth year, I'm left with a balance of 1 crore rupees. Why am I left with a balance of exactly 1 crore? Because if at the end of eighth year the holder does not choose to exercise the conversion option, I am obligated to pay cash of 1 crore, and therefore my books of accounts should have a liability of 1 crore rupees at the end of eighth year. All right. So this is like the question actually asked for the amount of interest expense across 8 years of the life of the bond. What is going to be the stream of interest expense? The stream of interest expense is not 6 lakhs of cash flow, but it is basically this particular column. It's this particular column which basically represents the stream of interest that is going to be recognized each year for the next 8 years. All right. So let's quickly actually compare it. If you notice, it's 7 lakh 8,000, 7 lakh 16,000. I think these were the same set of values that we also had. Let's quickly also just see the last year. If the last year is right, I can presume. All right, they have actually rounded it off in such a way that the amount comes down to 1 crore exactly. All right, remember, I actually had a balance of 1 crore 533. What they actually did is they ensured that this 1 crore actually comes down to exactly 1 crore. All right, they ensured that this closing balance comes down to exactly 1 crore, and they actually plugged the 533 in the last year. All right, so I had a value of I think 785 225. They have a value of 784 692, which is different as a result of rounding. All right, to ensure that this actually comes down exactly to 1 crore, they adjusted the interest expense for the last year. All right, so that is how you actually recognize interest. Now if you see what the way the answer is presented in the institute material as well, you have payment of 6 lakh every year, and the difference between these two is resulting in an increase in your bond liability of 1 lakh rupees each year. So you start with 88 lakhs, it is increasing every year by 1 lakh. So 88 becomes 89, 89 becomes 90, and that way you end up with a 1 crore balance at the end of eighth year. Let's now move to part C. The question is, provide the accounting entries if the holder of the bond elects to convert the bond into shares at the end of third year after receiving the interest for the third year. So at the end of 3 years, remember the conversion option was not existing only at the end of eighth year. The conversion option actually existed at any point in time. The bond can be converted at any point in time in the next 8 years. And over here, the holders have chosen to convert it at the end of third year after receiving the interest for the third year. All right. So now if you actually take a look at it, the value of the liability in the books of accounts at the end of third year after making the interest payment would be 92 lakh 1,821. All right. Since the third year has passed by, I would have recorded the interest expense at 7 lakh 26,000. And the question also mentioned that we have made the cash flow payment of 6 lakhs also at the end of third year. Therefore, the closing balance of the liability is going to be at the end of third year 92 lakh 1,821. The question is stating that what would be the journal entry. The question is asking what would be the journal entry if the investors choose to actually convert this bond into equity at the end of third year. Now, if you think of it, if the bonds are converted into equity shares at the end of third year, after year 3, I no longer have any liability to pay cash because it's now converted into equity at the end of third year. I am not going to pay cash of 6 lakh rupees of coupon also. Coupon will be paid only if bonds are outstanding. But now these bonds have been converted into equity shares at the end of third year. Therefore, I will not have an obligation to pay 6 lakhs and I don't have an obligation to pay the redemption amount also. Therefore, I do not have any obligation to pay any amount of cash to the investors after the third year. Therefore, what is actually recognized as a liability in the books of accounts should be de-recognized. I do not have a liability anymore because I do not have an obligation to pay cash. I do not have an obligation to pay cash. Therefore, the liability is supposed to get de-recognized. How do you de-recognize a liability? A liability is basically usually having a credit balance. This, remember, this 92 lakhs is a credit balance. It's a liability on your balance sheet. For you to de-recognize the liability, for you to remove the liability, you have to debit it. All right. You obviously have to debit the liability by 92 lakh 1,821. All right. So the first part of the journal entry will be with debiting the liability by 92 lakhs 1,821. All right. The liability had a book value of 92 lakh 1,821. Just like, let's say, when you sell a fixed asset, you credit the fixed asset at its book value. Over here also, we are no longer having a liability. Therefore, we are going to debit the liability of 92 lakh 1,821. Now, on initial recognition, if you recall, we had recognized an equity of 11 lakh 49,000. All right, the journal entry at initial recognition resulted in a recognition of equity of 11 lakh 49,040. We are actually now going to debit that as well. All right, we are now going to debit the equity component of debentures. All right, this is basically the liability component of debentures. We are also going to debit the equity component of debentures. Equity component will be at its book value of 11 lakhs. What was the value? 11 lakh 49,040. All right, the equity value does not change year after year. The liability component's value initially was recognized at 88 lakh 50,000. That became 92 lakh 1,000 at the end of third year. The liability value changes every year, but equity component value does not change every year. Whatever you recognized at the beginning of year zero, at the time of issuing the debentures, the same value exists at the end of year three as well, and therefore you debit it at 11 lakh 49,040. And now we will credit equity share capital because we are actually issuing equity shares. Remember, we are actually now issuing equity shares. Therefore, we are going to actually credit equity share capital. All right. So how the value of equity share capital to be credited will basically be the number of shares that we are issuing multiplied by face value. All right. The amount of equity share capital credited will be the number of shares that we are issuing multiplied by the face value. The question is, how many shares are we issuing? We are actually issuing one share for every bond. All right. We are actually issuing, each bond will be converted into one ordinary shares. If you look at it, the number of bonds that we had were 1 crore divided by 10 rupees. All right. The total value was equal to 1 crore divided by face value of rupees 10. The face value of rupees 10 is also given in the question. Therefore, the number of bonds that we issued were actually 10 lakh bonds. Each bond will get converted into an equity share. So 10 lakh bonds will get converted into 10 lakh equity shares. So we credit equity share capital with 10 lakh equity shares multiplied by the equity face value of rupees 10 again. All right. I'm considering that the face value of equity is also rupees 10, and therefore I credit equity share capital by 1 crore rupees. All right. Was the face value actually given in the question? I'm actually quickly checking. The face value of equity shares is actually not given. I'm assuming that the face value of equity shares is also rupees 10. So I'm crediting equity share capital at the number of shares that we are issuing. Number of shares that we are issuing multiplied by face value. All right, I'm crediting it by number of shares multiplied by face value, which is equal to 1 crore. Is this journal entry tallying? The answer is no. It's obviously not tallying. I still have a difference. The difference is going to be 92 lakh 1,821 plus 11 lakh 49,040 minus 1 crore rupees, which is going to be equal to, I have a difference of 3 lakh 50,861. All right, the debit side is actually higher than the credit side. So I'm having 3 lakh 50,861. I will be crediting this to securities premium or to share premium. All right, the difference is going to be recognized as a credit to securities premium. Share capital will be recognized at face value. Any difference, if it is a credit, it will basically be adjusted to securities premium. All right, that's basically as if I've received an amount at a premium value, and therefore I recognize a security or a share premium. All right, so what are we going to do? Basically, if it is getting converted at the end of third year, I will be de-recognizing my liability component and equity component at book value. Liability component at book value at the end of third year is 92 lakh 1,821. The book value of equity component does not change every year. Whatever was the book value of equity component on day zero, it's the same at the end of third year also. So we debit the equity component also by 11 lakh 49,000, and we credit share capital based on the number of shares that we are issuing multiplied by the face value. Any difference will be recognized in securities premium. Let us actually quickly look at the solution. Now in year three, basically we debit liability at 92 lakhs. We debit the equity component at 11 lakh 49,000. We have ordinary share capital of 1 crore, and we have the difference being recognized in securities premium at 3 lakh 50,861. All right. So this is how the journal entry will be if the bonds are converted into equity shares at the end of third year. So that is how we are solving illustration number two of the comprehensive illustrations that we actually have.